Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Venture Capital Investing 101, a complete guide for entrepreneurs and investors. Venture capital investing is a powerful force behind many successful startups. Have you ever wondered how some companies scale so quickly? Often, it's thanks to the financial backing of venture capitalists who see potential where others don't. In this video, we'll break down the basics of venture capital, what it is, how it works, and why it matters in today's business environment. You'll learn about the different stages of funding and the key players involved. Plus, we'll discuss the risks and rewards of investing in startups. Whether you're an aspiring entrepreneur, a seasoned investor, or just curious about the startup world, this guide will equip you with essential knowledge. Let's dive in and explore how venture capital can fuel innovation and drive economic growth. What is venture capital? Venture capital, VC, is a type of financing that investors provide to startups and small businesses. These companies often have the potential for high growth but lack the traditional means to secure financing. VC investors not only give money but also bring their expertise, networks, and resources to the table. This partnership can make a big difference in the success of a young company. Understanding the basics of venture capital. At its core, venture capital involves pooling funds from various investors. These funds are then invested in promising startups. In return, investors receive equity or ownership stakes in the company. This means that if the startup succeeds, the investors can make a significant profit. However, this comes with risks. Many startups may fail, leading to financial loss. The role of venture capital in financing startups. Venture capital plays a critical role in helping startups grow. Here's how it benefits both entrepreneurs and investors. Access to capital. Many startups can't secure loans from banks due to lack of credit history. VC funding provides crucial capital needed for product development and market entry. Mentorship and guidance. Beyond just money, VC firms often have experienced professionals who offer guidance. This mentorship can help startups navigate challenges and avoid common mistakes. Networking opportunities. VC investors come with extensive networks. They can connect startups with potential customers, partners, and even other investors. Increased credibility. Securing venture capital can enhance a startup's credibility. It signals to the market that experienced investors believe in the business. Support in scaling operations. With additional funding, startups can hire more staff, expand their product lines, or enter new markets much faster. The different stages of venture capital investment. Venture capital investments usually occur in several stages. Understanding these stages can help businesses determine when to seek funding. Seed stage. This is the very beginning. Entrepreneurs often seek small amounts of money to develop an idea or prototype. Early stage. At this point, the startup has a product and is looking to enhance its offerings and gain customers. More significant investments come into play. Growth stage. Here, the company has proven its model and seeks larger investments to expand further. This stage often involves scaling operations and entering new markets. Late stage. By this time, the company is nearing an exit strategy, like an IPO. Investors look for substantial returns as the startup matures. Each stage presents different opportunities and challenges, making it essential for entrepreneurs to understand where they fit. Conclusion. Venture capital is a lifeline for many startups and small businesses, providing not just money but also the support needed to thrive. Understanding its role and stages can help entrepreneurs make informed decisions about seeking funding for their growth. The venture capital process. Venture capital investing is a journey that involves multiple stages, each crucial for selecting and nurturing promising startups. Understanding this process can demystify how venture capitalists, VCs, operate and why certain investments succeed while others don't. Let's break down the stages of the venture capital process. Fundraising. Venture capital firms go through a fundraising phase to gather money from limited partners, which can include wealthy individuals, family offices, and institutional investors. This money creates a fund that the firm uses to invest in startups. Pitching. The VC firm presents its investment strategy and past performance to attract potential investors. Commitments. Interested partners make financial commitments, often pledging millions of dollars. Finalization. Once sufficient funds are raised, the firm can begin looking for suitable investments. Think of fundraising as assembling the necessary resources to build a house. Each limited partner adds a brick to the structure, making it possible for the firm to invest. Sourcing deals. Once the funds are in place, VCs need to find startups that align with their investment strategy. The sourcing process is vital and involves several key steps. Networks. VCs tap into their personal and professional networks to discover opportunities. Events. They attend pitch competitions, startup meetups, and conferences to meet startups. Referrals. They often rely on referrals from other investors and entrepreneurs. This phase is like a treasure hunt where the goal is to uncover the next big thing. Identifying promising startups requires a keen eye and the ability to spot potential in early-stage companies. Due diligence. Before making an investment, VCs perform due diligence, a thorough investigation of potential startups. This process involves various steps to ensure the startup is a solid choice. Financial review. VCs examine financial statements, revenue streams, and business models. Market analysis. They research the market landscape and assess competition. Team evaluation. A startup's leadership team is critical, so VCs evaluate their skills and experience. Due diligence acts like a safety net, helping VCs catch any red flags before they commit their funds. It's about making informed decisions, not just going with a gut feeling. Investment and structuring. After thorough due diligence, VCs decide how to structure their investment. This involves determining the type of financial instrument to use. Equity stakes. VCs often take ownership shares in the company, giving them a percentage of future profits. Convertible notes. Sometimes they opt for loans that convert to equity later, allowing flexibility in funding. The structure of an investment can significantly impact both the VC and the startup. It's like negotiating the terms of a partnership where both parties aim for mutual success. Post-investment support. Investing money is just the beginning. Once a VC invests, they often take on a supportive role to help the startup grow. This assistance can be invaluable. Mentorship. VCs may offer guidance based on their experiences. Networking. They introduce startups to potential customers, partners, and further investors. Strategic guidance. VCs often assist in shaping business strategies and navigating challenges. This ongoing support is like having a coach during a game. It helps startups stay on track and improves their chances of success, showcasing the value VCs bring beyond just capital. Understanding each stage of the venture capital process can shed light on how investments are made and how startups can succeed with the right backing. Types of venture capital. Venture capital is a crucial part of the startup world. Different types of venture capital fund various stages of a company's journey. Understanding these stages is vital for entrepreneurs looking to secure funding and investors seeking opportunities. Let's break down the main types of venture capital. Seed capital. Seed capital is often the first money a startup receives. This initial funding usually comes from founders, family, friends, or angel investors. It's used to turn ideas into reality. The significance of seed capital cannot be overstated. It helps cover essential costs like market research, product development, and initial marketing efforts. Imagine planting a seed. You need water and sunlight for it to grow. Similarly, seed capital gives startups the nourishment they need to start growing. Early stage funding. After securing seed capital, many startups look for early stage funding. This phase usually occurs when a company has a product and some initial traction in the market. Early stage funding helps startups scale their operations. They can hire more staff, improve their product, and expand their marketing reach. The role of early stage funding is like adding fuel to a fire. It helps the startup grow faster and reach more customers. Usually, this funding comes from venture capital firms that specialize in investing in newer companies. Growth capital. As companies continue to develop, they may seek growth capital. This type of funding supports established companies that are ready to scale even further. Growth capital is different from earlier funding stages because it focuses on expansion rather than just survival. Companies use this funding to enter new markets, launch new products, or even make acquisitions. Think about a tree that has grown tall and strong. While it's healthy, it needs more space and resources to spread its branches. Growth capital gives businesses the means to continue their upward trajectory. Late-stage venture capital. Late-stage venture capital is for more established companies that are close to going public or becoming profitable. This type of funding often comes from larger venture capital firms or institutional investors. The goal is to provide the necessary resources to ensure sustainable growth. Late-stage venture capital helps companies fine-tune their business models and prepare for the public eye. It's like a coach prepping an athlete for a big game, helping them focus and excel. By this stage, the company has a proven business model and is ready for the next big step. Understanding these types of venture capital is key for both startups and investors. Each stage serves a specific purpose and can significantly impact a company's success. Knowing when to seek funding and what type to pursue can make a big difference in the startup journey. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.